Hello everyone, this side Mayank Kothari. Today we are going to start a new chapter, that's corporate valuation. I hope you people are so excited about it because this is going to be the second last chapter and soon we are going to finish with the strategic financial management syllabus. So corporate valuation is the 12th chapter, sir, and it is covered under institute's 5th section, which covers under on an average 10 to 15% of the total marks. Now, talking about the practical aspects of the corporate valuation, around 8 marks of question can be asked. A practical question of 8 marks and a single question can be asked from the corporate valuation. So, one of the good part about the corporate valuation and mergers and acquisition is that you don't have to remember a lot of things in these chapters because most of the things like capital asset pricing model we are going to use, you have already learned about it. PE ratio, and Gordon's growth model. There are many concepts which we are going to use in the corporate valuation and mergers and acquisition, which you have already learned. So, reduce your stress level, or we can say, just relax and enjoy the chapter because we are going to solve a lot of practical question, and you are going to see that most of the part are taken from security valuation. First of all, please focus on this. The security valuation chapter is very much connected to the corporate valuation because both the chapters are related to valuation. The only difference is that this was the valuation of a single share, single bond, and this is the valuation of the entire company. A lot of things like free cash flows to firm, free cash flows to equity will be used in the corporate valuation, which was already covered under security valuation. Gordon's growth model was covered under security valuation. PE ratio was covered under security valuation. Capital asset pricing model was covered under portfolio management. So, concepts from the security valuation and portfolio management, most of the time you are going to use these. And the recently learned concept in the international financial management, that's geared and ungeared beta. So, most of the parts are already covered and we are going to solve practical questions. Okay, so corporate valuation, there are around 44 practical questions in this chapter. And few questions are repeated questions, like just the values are changed, and then institute have given these questions in the next exam. So out of 44 questions, 12 questions are going to be your homework. Okay, I will just mark those questions, and rest of the 32 questions will be covered in the class. And I'm estimating around 4 hours or maximum 5 hours it will take to complete all the questions. So because the length of the question, out of 32, I think 5 to 7 question maximum will be large in terms of answer, but all the other questions are very small. So we are going to cover those in an average, we can say 5 to 6 hours maximum we will cover the corporate valuation. Okay, sir. So 8 marks of practical question can be expected, and I think this is one of the scoring chapter. Like you can score easily in the risk management, 8 marks from the risk management, and mutual fund 8 marks, 16. Easy chapters, right? And corporate valuation is going to be another chapter for 8 marks, so 24. So 24 marks under practical part, easiest one. And then we can say, if we consider theory, then first chapter 4 marks, and securitization 6th chapter 4 marks, and the start of finance 4 marks. So these are the small chapters from which you can easily cover the marks. So this is 12 marks and 24 marks, around 36 marks can be covered without much of the efforts. Like, obviously you will have to learn and study these concepts and give some time, but the time taken to cover the same marks in other chapters will be double or triple. So you can save 2/3 of the time in these chapters that I just told you to cover the same marks. So that's how the smart studies should be. Okay, so corporate valuation, let's first discuss about the concepts that we are going to cover under this chapter. And you can see valuation using PE ratio, dividend model, book value, net realizable value, range of valuation, PE multiple, range of valuation, market price and discounted cash flows. Then earnings capitalization method, net asset value method, discounted cash flows, net worth, dividend valuation model. Chop shop approach is something that we are going to learn. Value of the firm, then free cash flows to equity, then cash flows, value of the firm, value of the equity, enterprise value, economic value added. You can see a lot of questions on economic value added. So, and then relative valuation. So I have summarized the concepts that we will be covering in all those 44 questions. Let's go through it. See, so these are the things that we are going to cover. Now, I will just mark all those concepts that we have already covered in some other chapters, so that you will get to know that out of these concepts, how many have already been covered in the previous chapters and how many we will be learning. Okay, have a look. So P ratio was already covered in the chapter security valuation. Fourth chapter dividend growth model. Fourth chapter book value is something which is very easy to learn. Net realizable value, market value. Fourth chapter discounted cash flow. Fourth chapter earnings capitalization. You will learn this. Net asset value, chop shop approach. This approach was already learned by you in free cash flow to firm and free cash flow to equity in security valuation. So most of the thing, enterprise value in fact was covered also in the security valuation chapter. Now the other parts like book value and we can say net asset value are very small and easy to understand. So let's cover and let's start with the practical part of this corporate valuation. We will start with the first question directly and we'll see how many concepts will be covered under all the questions that we are going to see. Okay, sir. Let's start the journey of practical questions of corporate valuation. Now, before starting the practical question, just keep one thing in mind. These are the ways. See, understand what is exactly this. These are different methods, approaches, and ways to calculate the value of the entire company. Corporate valuation itself means you are going to value the equity, value the debt, or value the entire firm. So if you let's start with one thing. If you want to calculate with the PE ratio, how will you calculate the price of one share? It's very simple, sir. Market price is equal to PE ratio into EPS. See, once you multiply this with the earning per share, you will get the market price of one share. But when you multiply the PE ratio with the total earning after tax, then you get the total market value. That's it. If you take the earnings per share, you will get the market price per share. But if you will take the total earnings, you will get the total market value of the company. Acha. Next is the dividend growth model. Under the dividend growth model, if you take D0 in bracket 1 plus growth divided by cost of equity minus growth, you will get the price of one share. But instead of taking the dividend per share, if you take the entire dividend here in the numerator, you will get the value of the entire company. That's how we have to calculate. What is book value, sir? Book value is nothing but equity plus reserves and surplus, or we can say total assets minus total liabilities. Okay. Net realizable value, the data will be given in the question that if the fixed assets worth 50 crore is can be realized only at 30 crore. So we will consider 30 crores. So under the book value, net realizable value or net asset value, we take the balance sheet into consideration and adjust that balance sheet for the changes that has to be made. And the net total of, or we can say net worth, is calculated out of that. Then the market value is very easy, sir. How to calculate the market value of a share? It's market value of the total company. It's market price per share into number of share. How difficult is that? Discounted cash flow method. This is one of the most important part of this chapter. because we are going to use this concept a lot of time. And discounted cash flow method means if you want to calculate a market value of a company today, what you have to consider is you take the future cash flows. Let's say for example cash flow 1, 2, 3, 4, and discount them. Okay, discount them at the respective discount rate, and at the end of the fourth year, if the question says that there will be some perpetual cash flows, then you will end up calculating terminal value at the end of year 4. And you have learned that in the security valuation the concept of perpetuity is still used, which was learned in the under the basics of time value of money. So terminal value 4 can be calculated with the help of the cash flow for year 5th. Next year's cash flow is taken to calculate the terminal value, and then you can take cost of equity minus growth, and then you can discount this one also. So the total of all these cash flows, that means let's say for example the discounted cash flow for the fourth year and the discounted value of the terminal value will consider or will we can say will explain the present value of the future cash flows of the company. And in terms of present value, if the entire future covers around 747, let's say for example crore, that means this is the present value of what we are going to receive in the future by running this company, and that should be the market value. If you are not going to receive more than that, how will you explain the value of a company more than that? So 747 will automatically become the market value or the value of the company. This is nothing but the present value of future cash flows. And in the question it can be like up to 4 years they will give you the data, and then they will say that perpetuity will be there. Up to 5 years they will give you the data, and then they will say that the perpetuity will be there. So there are lots of varieties under the discounted cash flow method. Let's come to the earnings capitalization method. What are you going to do under earnings capitalization method? It's very simple, sir. You calculate the future maintainable profit, or we can say earning after tax, which will be earned in the next year. So if 1 year's earning is this much, let's say around 20 crore, and if your required rate of return is around 10%, then the value of the company becomes 200 crore. Again, the value, again, this is based on the perpetuity concept. I will just show you. Let's say, for example, if you invest in a company around 200 crore and you expect a minimum return of 10% every year. So the return should be 20, right? Of return for the first year should be 20. So can I do the reverse? If the return for the first year is 20 and 10% is expected, then the value of the company will be 200. Exactly. And this is called as capitalization factor. This can be cost of equity. If you want to calculate market value of the equity, then this will be cost of equity, and this will be the earnings for the equity. If you want to calculate this as the market value of the firm, then this should be the cost of the firm, and this should be the earnings for the firm. We'll learn about that. But it's very simple. Earnings capitalization method means you capitalize the earnings. Capitalization factor will be the required rate of return. You calculate the net earnings divided by the factor, and you will get the market value of the company. Again, based on the concept of perpetuity. Net asset value, total assets minus total liabilities, will be the net assets. Chop shop approach, we are going to learn this. Free cash flow to firm and free cash flow to equity. What does that mean? Whenever you want to calculate free cash flow to firm, that means you will deduct everything except for the interest payments to the debt, dividend payment to the equity, principal repayment to the debt, or any debt issued. So except the payment or receipt from equity and debt holders, all the other cash flows will be considered. Mostly it's like, if you remember, if you take EBIT, then we will take EBIT 1 minus tax plus depreciation, tax saving on depreciation we can say, and tax saving on depreciation has been taken. Then change in the capex capex, capital expenditure, minus change in working capital. All these parts are taken. We will learn about that also. I will just make sure that you revise these concepts from the security valuation. But when you calculate the free cash flow to equity, then you deduct the interest as well. Then you deduct the principal repayment as well. So you reach to a level where the cash flows left are only for the equities. No one should have the right except from the equity share, except for the equity shareholders on these cash flows, and then you can say these cash flows are free to the equity. Free cash flow to firm and free cash flow to equity itself means that the cash flow should be free for these people. The firm includes two types of people, or that is equity and debt, and equity includes only equity. Except for these, you should deduct all the cash in inflow and outflow, and then the balance left will be considered as free cash flow to firm and free cash flow to equity. Then we have learned about something about the enterprise value. If you remember, market value of equity plus let's say market value of equity plus market value of debt, because this is what you have to pay after acquiring the company, plus market value of preference share if there is any, then we can say less cash and cash equivalent. So this will become the acquisition price of the company. So just the market value of equity will give you the ownership of the company, but this is not the only cost that you will have to pay to acquire the company. After acquiring the equities, you will have to make the payment to the debt holders also. So consider that also in the value of the company, preference shares as well. But once you acquire the company, the cash balance is all yours. So you can deduct that amount. See, let's say for example, this is a box and there is a 10 rupees kept in this box. Now understand that if I'm buying this box for 50 rupees, it is ultimately costing me only 40, because the moment I will take that box, I will keep that 10 rupees in my pocket. So I paid 50 and I received 10 back. So the net cost of acquisition is only 40. That's why we deduct the cash balance. This is what the enterprise value is. And then we are going to learn a new concept called as economic value added. So all in all, most of the things are familiar to you. Okay, sir. So this was just an introductory part for the corporate valuation. If you have understood few things in that, it's very, very good. But otherwise also we are going to cover each and everything out of this in the practical question. Let's take a break of 5 minutes and I will be back with the practical questions. So welcome back after the break and have a look on this first question. Sun Limited recently made a profit of rupees 200 crore and paid out 80 crore, which is slightly higher than the average paid in the industry. What is that paid out? That might be the dividend. Okay. The average PE ratio, have a look. This is called as earnings after tax. This might be dividend. And average PE ratio of the company is 9. The estimated beta of Sun Limited is 1.2. As per the balance sheet, the shareholders fund is 450 crore and the number of shares are 10 crore. In case the company is liquidated, that means in case of liquidation, building would fetch 200 crore more than the book value and stock would realize 50 crore less than the book value. Now, the other data of the industry is as follows: the projected dividend growth rate, risk-free rate, and the market return. Calculate the valuation of Sun Limited using PE ratio. So this is growth rate, risk-free rate, and market return. You know it very well that when these kinds of data is given to you, we have to use the Gordon's growth model most probably. PE ratio. Now we have to calculate the valuation of Sun Limited, means a valuation of the company. PE ratio is very simple, sir. Market value is equal to PE ratio into total earnings. Because if you want to calculate the market price per share, then take the earnings per share. If you want to calculate market value, then take the total earnings. So that's 9 multiplied by 200. Am I right? 9 multiplied by 200, 800, 1800 crore. Now comes the dividend growth model. Market value is equal to, I will take total dividend because I need total value, into 1 plus growth divided by cost of equity minus growth. The total dividend is 80 crore which has been just paid, higher than the average paid. They paid out, that means it is D0. And the growth rate is 1.04 divided by cost of equity. We need the cost of equity which can be calculated using CAPM. That's around risk-free rate plus beta in bracket market rate minus risk-free rate. Can we use all this data? Like risk-free rate is 6, the beta is 1.2, market rate is 11 minus 6. So that's 5 into 1.2, 6 and 6, 12% is the cost of equity. And this will give you the market value. See, 12% is the cost of equity and 12.0, 1.0, 1 into 1.04, and then this is the market value. Then the last one is the book value. See, clearly shareholders fund is 450 crore. The balance sheet is showing this value and that becomes the book value automatically. And the last one is the net realizable value. That means if you go into liquidation, then what will be the total value? It's very simple, sir. You take the book value, 450 crore, and this is the book value. But if you go into liquidation, question clearly says that you will receive 200 crore more in case of selling the building. So, more than the book value. That means whatever the building's value is there in this 450, you will receive 200 more. So add 200 to 450 and deduct 50 crore of the stock. Because whatever is the stock's value in this book shareholders fund, the book value, stock will not realize at that entire amount. It will fetch 50 crore less. So add 200 crore and deduct 50 crore. See, 450 plus 200 crore minus 50 crore. So according to realizable value, it's 600 crore. According to book value, it's 450. Gordon says it is 1040 crore. And the earnings capitalization, or we can say P ratio, says 1800 crore is the value of the company. So these are 4 different methods. What have been covered? P ratio, dividend growth model, book value, and net realizable value. All these 4 concepts are covered, and that's pretty easy. Okay, sir. Then coming over to the second part. This second question is very easy. All this is again using the P ratio model, the first model that we have used. So you take that as an homework. I will just show you here. This is the EPS, this is the P ratio. See, this is the P ratio, and then you will just multiply it to reach at this value. Okay. Then the value of the share. 3.4 into 4, 3.4 into 5. It's very simple. 4 into, just a second, 4 into 7, 28. Okay. Question number 3 now. ABC Limited is considering acquisition of DEF Limited. Now this might seem a question of mergers and acquisition, but most of the part is related to the valuation. So that's why we have covered this question in this chapter. So acquisition means DEF Limited is being bought by ABC Limited. So obviously ABC Limited would need to value that company, the company that we are thinking of buying. We are just considering, na? So we are thinking of buying DEF Limited, which has 3.10 crores share issued and outstanding. So this is the number of share. The market price per share is 440. Sorry. ABC Limited average cost of capital is 12%. So understand few things. I will just write down the given data. For ABC, the cost of capital is 12%. For DEF, the number of shares are 3.10 crore. Market price is 440. And the cash inflows of DEF Limited and the cash flows of DEF Limited for the next 3 years are given. You are required to calculate the range of valuation. Whenever it says range of valuation, you need to calculate upper and lower range. That means two values in which the final price of DEF Limited will be decided. So what happens when you calculate the range? Like you consider the range. Range means the upper and lower value, the maximum that we can pay and the minimum that we should pay for a company. So whatever will be the negotiation between these two companies, that will happen in this range. Now that means we have to calculate two values of this DEF Limited that we are going to buy. And what is the data given in the question? There are only two ways which you can be used to calculate two values. The first one is the market value. So market value is equal to simply market price into number of share, which will be 440 into 3.10, and that's very easy. 440 into 3.10, that comes to 1364 crore, right? This is one of the way to calculate the value of the company. The another way is to use the cost of capital and use the cash flows. The second method is the discounted cash flow method. What you should do is, after buying this company, if this is the cash flow that we are going to receive, let's say for example this company is going to only run for 3 years. So 460 will be received, 600 and 740 will be received in the respective year. How much you should pay to buy such a company which will fetch this much of the value in the coming 3 years? Very simple, sir. Calculate the present value of all these cash flows. So just start with the exact table. I will just take these values here. So what you can do, the next column can be present value factor at 12%, because after buying this company, we need a return of 12%. The person who is buying this company, ABC, needs a return of 12%. Why ABC needs a return of 12%? Because whatever the ABC is going to pay to DEF Limited for buying the company, that capital is not available for free to ABC Limited. ABC Limited borrows that capital from the equity, debt, preference or whatever sources from the market. So what the ABC is going to do, ABC is going to borrow that capital on which it has to pay 12% as the cost. So in order to satisfy the investors of ABC Limited, whatever the investment ABC Limited is going to do in DEF Limited, ABC should make sure that 12% is at least the return. That's why we are discounting all the cash flows that will be, we can say that will be received in the coming year by 12%. That is the minimum rate of return. If NPV at the required rate of return is 0, that means the exact return in the project is the rate at which you calculated the discounts. If the NPV is higher than 0, that means you are earning more than the discount rate. And if the NPV is less than 0, that means you are earning less than the discount rate. Okay, so present value factors are given for the 12%, that's 0.893, 797 and 712. You calculate the present value here for all, and this is going to be your next range of value, that is part of the range of the valuation. Have a look. 1364 crore, and once you multiply with the discounted value, the discounted value is this much. Can I say that the range of value is, the range of valuation is, this is the upper limit and this is the lower limit. So market value says that this company is worth 1364 crore and discounted cash flow says that this company is worth 1415 crore, 1415.86 crore. So both the parties will do the negotiation, and something in between these two, something in between 1364 to 1415.86 will be finalized for this company DEF Limited. That's the range. This is per share range. This is total value of the range. In order to calculate the per share, you just have to divide it by number of shares. Next question, sir. Question number 4 is homework. See, question number 4 is homework because this is pretty old question and the chances are very less. So you can just go through it once. That's nothing is difficult in that. You just have to multiply the values with the probability and get the total. Okay. Coming over to question number 5. This is an interesting question. XN Limited. Acha, the question that we have just seen, the question number 3, considers which type of concepts? Like these concepts. The concept number 5, market value, and the concept number 6, discounted cash flow method, were covered under this question number 3, right? Okay. Now let's move on. XN Limited reported a profit of 100.32 lakhs after 34% tax. So this is profit after tax, right? Can we calculate profit before tax with the tax rate given to us? Yes, sir. Because 34% has been deducted and after that 100.32 has been arrived. We can easily calculate profit before tax as profit. Just understand this process. After tax divided by 0.66. Because 34% is the tax, so the balance amount is 66%, or we can always write it like this, 1 minus tax. So this is the formula for calculating profit before tax out of after tax. Okay, sir, what will be the value then? 100.32 divided by 0.66, it comes to 152. This is profit before tax for the financial year 2015-16. An analysis of the accounts reveal that, so someone has done this analysis and it reveals that the income included extraordinary items. This is the income included extraordinary items of 14 lakhs and extraordinary loss of 5 lakhs. So there is an extraordinary income of 14 lakhs and expense, we can say, of 5 lakhs. All these are extraordinary. Understand what do you mean by extraordinary? Extraordinary, it means this will not be incurred in future. That's why it says extraordinary. It has incurred in this year or the past year, but you are not going to earn an income of 14 lakhs in the next year as well. Ordinary income is something which is repeated year after year. I will just give you an example. Let's say I'm running a Conferenza Next Private Limited. This is a company which sells video lectures to the customers, to books to the customers, okay? And let's say the profit is 10 lakh rupees for the year, okay? Now this profit can be repeated to the next year as well. But on a particular year, apart from this 10 lakh rupees, let's say I sold some fixed assets of the company, computer, table, chair and all that. I sold old fixed assets and I earned around, there was an earning in the fixed assets of around, we can say 1 lakh rupees. So the total earning of this company in this year is 11 lakh, but I can clearly say that 10 lakh is from the ordinary business and 1 lakh is from the sale of the fixed assets. Okay, and try to understand, this is an extraordinary income. Every year I'm not going to sell the assets of the company, right? It is not practically possible. Every year I will sell the video lectures and the books as well, but selling this is not possible. So if you want to value the company, just ignore the sale of fixed assets or the earnings or income from fixed assets. Any item which is extraordinary should not be counted for the valuation of a company, because that extraordinary item will not be repeated again. So that is actually not a part of the income that you should consider for the future. So that's why what we are going to do, out of 152 lakhs, 14 lakhs was an income that was added to the income, right? In the profit, income is added and expense is deducted. We are going to just reverse this by reducing the income of 14 lakh and adding back the expense, so that the impact of 14 and 15 is removed. So what are we going to do? Minus 14 plus 5. So that goes to 143, if I am right. Acha, one more thing. The existing operations, except for the extraordinary items, are expected to continue in future. Practically speaking, this statement is not required in the question. This has to be assumed, or the students are expected to be this much smart that they understand this process, that extraordinary items are not going to continue in the future. Further, a new product is launched. Now understand, there is some income which is not included in 152, which is related to the new product because we have just launched it. But from the next year onwards, forever, we are going to earn some income from that. So this is something which is not included till now because the product was not launched yet, but it should be included, because this will be the part of income from the next year. So whatever is the income from this part, you are going to include that. A new product is launched and the expectations are as under. We are going to make a sales of 70 lakhs. Material, labor and fixed cost will be 2016 and 10 lakhs. So the total cost will be 46 lakhs minus 70. So 24 lakhs will be your profit from this business, right? So you can add that 24 lakhs as well. So 143 plus 24 goes to around 167, if I have not made any kind of a mistake. The company has 50 lakh equity shares of rupees 10 each and 80,000 9% preference shares of rupees 100 each, with PE ratio being 6 times. Okay, so PE ratio being 6 times. If we multiply the PE ratio with earning per share, we will get the market price per share. Understand? Market price per share, and if we multiply the market price with the number of share, we will get the market value. Cool. Now Acha, understand this preference shares as well. 80,000 9% preference shares of 100 each. So 80,000 into 100. So total value of the preference in the company is 80 lakhs. Right, on that 80 lakhs, you are going to pay 9% dividend, which comes to 7,20,000. Do you understand how this dividend is represented? It's very simple, sir. When you arrive at the profit before tax, okay, you will pay the taxes, and after the and from profit after tax, you will deduct the preference dividend. Then this profit after tax will be available for the equity shareholder, which can be divided with the number of share to arrive at the earning per share. And this earning per share, when multiplied by the PE ratio, will give you market price of the share. Am I right? And this market price, when multiplied with the number of share, will give you market value of the share. So this is the process. This dividend, preference dividend, is adjusted in the profit after tax. So what is given in to you in the question in the very first line is the profit after tax, means 100.32 lakhs is before deducting the preference dividend. We will see that. Now what is required? Compute the value of the business assuming the cost of capital is 12%. Value of the business and the market price per equity share. It's simple. If you calculate the value of the business, you can just simply divide the value of the business with the number of share to arrive at the market price. Right. How to do that? It's very simple, sir. Adjust all the profits. See, do you get this figure of profit before tax 152? Then we said that we will remove this income and we will arrive at 143 of the existing profit. And let me just show you. It is like taking a load. I don't know why. See, out of 152, we will adjust the extraordinary items, and then we will add the profit from the new product. So total will be 167. The total profit before tax will be 167. Okay. See, 167. Since you have reached at this, you understand that this is a profit before tax. You deduct the taxes out of it again, and this will become future maintainable profit after taxes. Future maintainable profit after taxes, 110.22. Now, relevant capitalization factor is 0.12. Now, once you divide this becomes, we will call it as earnings capitalization method. And what you are doing is you are capitalizing this earning with the required rate of return to calculate the value of the business. That means if you invest this much today in the company, and at this rate you are going to earn this much, 110.22 every year. Now this includes the preference dividend. What does that mean? This is the earning for equity shareholder plus preference shareholders, because the preference dividend is not yet deducted out of 110.22, right? Let me just see if the preference dividend is given separately or included in that. Yeah, included in that. Now understand, this profit is for the equity shareholder and the preference shareholder. What does that mean? It means that the equity dividend and the preference dividend should be paid out of this profit. And this capitalization, oh sorry, wait a second. Yeah, and this 12% is the weighted average cost of capital, which is arrived at after weighted average calculation of cost of equity and cost of preference share, like this. So we calculated the weighted average of the both equity and preference shares cost and then arrived at 12%. So this earning relates to both, cost relates to both, and the value also relates to both. This is not just the equity's value, this is the business's value, which includes two types of capital, equity and preference share. So this is like it. Now they are asking market price of the equity share. Once you have to calculate anything for the equity, you have to make sure that first you pay out all the other liabilities. That means first you will pay everything to the other investors like preference shareholders, debt holders, or loan or anything. Now this is the future maintainable profit. The first responsibility for an equity shareholder or the owner of the company is to make the preference dividend. So deduct the preference dividend out of it. The remaining balance will be available for the equity shareholder, which can be divided by the number of equity shareholder to arrive at the EPS, which will be multiplied by the P ratio as I suggested in the previous page. And then this is the market price, which was asked by the question. That's it. Simple. Easy. Now coming over to question number 6. Question number 6 is exactly like the question number 5 with little changes. This is something reverse that we are going to do. Have a look. See, in question number 5, you have been asked to calculate the market price, but in question number 6, in the very first line itself, they have already given you the market price. So you are going to do the reverse calculation. Now just prepare your mind to do the reverse calculation. Like from this part, understand, from this part you will go like this. So instead of deducting the preference dividend, you will add it to arrive at this point, and then you can calculate the value of the business, and then you will be asked to calculate the this price, profit from ordinary business. So you will go like this now. Have a look. The closing price of the LX Limited is 24. I will just start it by writing everything just beside the previous question, 24. Okay. Now the PE ratio was 6. So the PE ratio is 6. What will happen? We can calculate the EPS as 4. Am I right? 24 by 6 is equal to 4. Okay. It was found that an amount of 24 lakhs as income and extraordinary loss of 9 lakhs were included in the books of accounts. So 24 and 9. So let me write it. This is 24 and this is 9 in the new question. Okay. We'll adjust that later on. The existing operation except for the extraordinary items are expected to continue in the future. This statement is not required. Further, the company has launched a new product during the year with the following expectation. Have a look. Now, these are the expectations. And you can see if we deduct 150 if we deduct all the cost from sales, 150 minus 40 minus 34 minus 24, it goes to 52. Right, so 52. Can I write down this 52 here in place of this? What else? This is loading, unnecessary, taking time. Okay, the company has 5 lakh equity shares of rupees 10 each. 5 lakh equity shares of rupees 10 each. And 1 lakh 9% preference shares of rupees 100 each. So when you multiply 1 lakh with 100, this becomes around 1 crore. And on 1 crore, if you will pay 9% preference dividend, it will be 9 lakh rupees. The PE ratio is 6 times already given in the question. Post-tax cost of capital is 10% per annum. Tax rate is 34%. Calculate the existing profit from old operations and the value of the business. So you are going to go reverse now. How to do that? See, you took the, I'm not going on the previous page because it is taking a lot of time to load the page. So from here and there, we are going to just shuffle it. So I'm just explaining this. Have a look. PE ratio into market price is 24 divided by PE ratio. It will give you EPS multiplied by the number of share. It will give you the profit after preference dividend. Please understand, because this is EPS related to equity shareholders. This is EPS. When it was multiplied by the number of equity shareholders, it gave you earnings available for equity shareholders. And in that, you are going to add preference dividend to arrive at the future maintainable profit, right? Once you take this future maintainable profit with the help of the cost of capital given in the question, you can calculate the value of the business. This is the first part, or I think the second part of the question. And from this future maintainable profit after tax, you are going to adjust the taxes and then these expenses, extraordinary and the 52 of the new product. Okay, let's have a look now. See, so this is profit after preference dividend. I added the preference dividend in that, which comes to 100 multiplied by 1 lakh into 9%. So this goes to profit after tax. Once you add it, it becomes profit after tax. And once you divide it by 66%, you will get the profit before tax. This is the income which includes all the extraordinary item. Now you start again from this, deduct extraordinary income from this, add extraordinary losses. This is the existing profit from old operation. Question exactly asked this. Existing profit from old operation means without new product launch. Forget about the new product launch. Just tell us what is the existing profit from the old operation, and in that you are going to add this 52 lakhs, the profit from the new product, and you will arrive at the profit before tax again. Then deduct the taxes to arrive at the profit after tax, and then capitalize that with, I think, 10%. Yeah. So this is future maintainable profit. Capitalize it, you will get the value of the business. Exactly similar to the previous question. Okay, sir. Now this is one more question which is exactly similar. Question number 7. And I will just give this as a homework to you. Yes, this is again profit after tax of 30%, extraordinary loss, extraordinary income, sales minus these cost, calculate value of the business, market price per equity share. This is related to the preference shares, P ratio, everything is same. So you can take this as homework. Question number 7. Let's start with question number 8. Now, we are done with this earnings capitalization method, right? In this 3 questions that we have discussed, what we did is we calculated the future maintainable profit. I just told you here, future maintainable profit or earning after tax, and then divided by the cost of capital. See, then divided by the cost of capital to arrive at the value of the business. Question number 8 now. Given below is the balance sheet of S Limited as on 31st March 2008. It is very long. Liabilities, share capital of rupees 10, 100, reserves and surplus 40, creditors 30. Land and building on the other side, on the asset side, we can see 40, plant and machinery 80. Investments 10, stock, debtor, cash at bank. Okay. You are required to work out the value of the company's share on the basis of net asset method. Okay, so there are 2 methods that we are going to use. Net asset method and profit earning, or that means profit earning capitalization method. This is nothing but the earnings capitalization method. and arrive at the fair price of the share by considering the following information. So first we are going to calculate the value of the share using net asset value method and P multiple, or we can say earnings capitalization method. And then we are going to arrive at the fair price of the share. There will be some, I think, values given to this. Okay, we'll talk about it later on. Profit for the current year is 64 lakhs. This is for the earnings capitalization method. So I will just write down the information. This information is for earnings capitalization method. See, profit for the current year of 64 lakh includes 4 lakh of extraordinary income and 1 lakh of income from the investment of surplus fund. Such surplus funds are unlikely to recur. That means these 5 lakhs will not be incurred again, and both of them are income. We have to adjust that in 64 lakhs. In subsequent years, additional advertisement expenses of rupees 5 lakhs are expected to be incurred each year. This is again related to earnings capitalization method. That means they are saying that from the next year, 5 lakh rupees will be the additional advertisement expenses. So you should reduce your profit by this much amount. Now the third part, market value of land and building and plant and machinery have been ascertained at 96 lakhs and 100 lakhs respectively. So this information is related to the concept of net asset value. And the new values for land and building is 96 and 100 lakhs. What is net asset value, sir? Total of the asset side minus the liabilities, that means creditors. Only this much of the liability, not equity and reserves. Exclude the equity and reserves out of it, because that is what we want to calculate. And the total will come to 140. But do not directly take 140, because what we are going to do is we are going to adjust the assets with the new values. So land and building should not be taken at 40, but it should be taken at 96, plant and machinery at 100, and then the total of the asset should be done minus creditors. Okay. Apart from that, this will entail, because of the new values of land and building and the capital, we can say plant and machinery, this will entail additional depreciation of 6 lakhs. Depreciation is a part of profit and loss account. It will be used under earnings capitalization method. So net asset value is something related to the balance sheet items, and earnings capitalization method is related to the profit and loss items. Effective income tax rate is 30%. Capitalization rate applicable to similar businesses is for 15%. So this is overall cost of capital. Now the profit that has been given in this question, 64 lakh, should we take it as before tax or after tax? It should be taken as before tax, because first thing, there is no clarity that it is after tax profit. In the previous question, if you go and have a look, just a second. See, it was clearly written profit of 100.32 lakhs after 34% tax, and at that time we consider that as a after tax profit, but now this will be treated as a before tax profit, 64 lakhs. Okay sir, capitalization rate will be considered for earnings capitalization method. So now how to calculate? That's it. How to calculate? It's very simple. Net asset value means total assets minus total liabilities. So do the total of these: land and building, plant and machinery. See, this is 10, 20, 15. Rest of the figures will be same. This comes to 246 and less creditors. So 246 minus 30 will give you 216 as the net asset value. Am I right? And if you divide that by number of shares, which is 10, how did you calculate the number of shares? 100 divided by the face value. So it will give you per share price of 21.60 according to net asset value method. Now coming over to the profit earning capitalization method, start with the PBT of 64 lakhs. Am I right? And exclude all the items which are not going to be incurred again in the future. So the income of 5 lakhs will be excluded. That means we are going to reduce that. Now the profit is only 59 lakhs. Apart from that, there is an additional advertisement expense of 5 lakhs. Okay, so that will also be adjusted. Advertisement expense will again reduce the profit, so we are reducing it. See, and the moment you complete a particular treatment, now put a habit of marking it like this. That means nothing from this particular part should be treated again or considered again. And in this question, we have covered this 96 and 100 lakhs in the net asset value. Let's cover the depreciation. Additional depreciation will be 6 lakhs. So 59 minus 5 minus 6. That now profit is 48 lakhs. What else is left? Nothing. So out of 48 lakhs, you can deduct 30% as the profit. Am I right? So less 30%. The new profit is 33.6 lakhs, which can be capitalized with 15% rate of return. Am I right? 15%. And the new value will be 224. This is the earnings capitalized value. This is the earnings 33.6 lakhs. This is called as future maintainable profit capitalized at 15%. So the new value is 224 and then divided by 10. So the new value per share will be 22.4. According to NAV, it is 21.6. According to earnings capitalization, it should be, just a second, it should be 22.4. But there is a different answer for earnings capitalization method in the answer given by the institute, and I will show you the difference. Okay, first of all, let's match our answers with for the NAV method. Have a look. This is 21.60. Do you agree with this now? Okay, now coming over to the profit earning capacity method or earnings capitalization method. You started with 64, deducted 5 lakh, 59, then arrived at 48. Okay, income tax, then arrived at this much. So till this point, or we can say till this point, all our answers are matching with the institute. But the main problem is this creditors, 30 lakhs. Now, clearly the treatment given by the institute as long-term debt is correct. But how will you know about this in the question? Just a second. If you look at the question, they are simple creditors. No one knows that these are long-term creditors, long-term lenders. Is this a long-term loan or a creditors for the business that we undertake? This is a simple creditor given in the question. In the entire question, no information is given that this is not actually a creditor, but this is a loan taken by us. And if this is a debt, then obviously deducting that is correct. If this is a debt, then deducting that is correct, because at that time this 224 will be the value of equity and debt both. We need to calculate the value of equity only. So we will deduct the debt out of the total value of the business. Okay, so there are two options for us now. If we change, either we change the question or we change the answer. But whatever we do in this lecture will not be important. What exactly you have to do if such a question is asked in exam? You will consider this creditor as a normal creditor and will not deduct it from the value of the company. But if there is something specific in the question that these creditors are related to the long-term debt, then you should deduct it. Now, what I'm doing, I'm changing my answer, assuming this as a debt. If I assume this as a debt, the answer will change to a certain extent. Now, what will that mean? What does that mean is that this 33.6 lakhs is earned for two people, equity and debt holders. Acha, one more thing which can be ambiguous in this question is that if there is a debt holders, where is the interest? Why didn't we deduct interest? So that is little ambiguous part. Okay, so this earning will be for equity and debt. This is the cost of capital weighted average calculated from equity and debt. So this market value, that means the value of the business, is also for equity and debt. And that's why what you are going to do is you are going to reduce the value of debt out of total, which is going to be 194. Now this is left for equity, because out of the value of equity and debt, you have reduced the value of the debt. Now the whatever left is for equity only. Now you divide it by 10 and the new value of the equity will be 19.4. Have a look. See, 19.4. So this is little ambiguous. What I want to say is the treatment given by the institute is not wrong, but the information that this was a long-term debt should have been given in the question. and at that time deducting it is correct. $19.4, $21.6. You can average both of the values. See, fair price of the share, net asset value 21.6, profit earning capitalization method 19.4. You can average out both the values to find out one single price, which is 20.50. The average of the both. That's it. So this was question number 8. I hope you understood this question. Question number 9 is pretty much similar to what we have learned in question number 8, but in a different manner we are going to calculate. In the previous question we took the average of both, but what if the weights are given for net asset value method and earnings capitalization method? If there are some weights given, let's say the weight of 3 is given to net asset value and 1 is given to capitalization method, then what are you going to do? You are going to multiply it with 3, multiply it with 1, and then add it and then divide the total by 4 to calculate the price. If separate weights are given, 3 and 1 means 75% and 25% importance. That's it. Okay. I will just remove it for now. Let's read the next question. H Limited agrees to buy over the business of B Limited. So B Limited is being acquired by H Limited. The summarized balance sheet of both the companies are given to you. H Limited. See, how many number of shares are there for H Limited? Can I say 350 lakhs divided by 100? That means 3.5 lakhs. Yes, sir. And 6.5 divided by 10, that means 0.65 lakhs for B Limited. Reserves and surplus, total assets, net fixed assets, net current assets, deferred tax assets. Now, these are the terms. The weighted average post-tax maintainable profits of H Limited and B Limited for the last 4 years are 300 crore and 10 crores. For the last 4 years. Okay. Weighted average is given to us. That means average future maintainable profit for H Limited is 300 crore and for B Limited is 10 crore. Okay. So this will be applicable. There are two methods, right? Again, there are two methods, the same net asset value and the earnings capitalization method. So I will divide all the information according to the requirement. So I think this requirement will be useful only in the earnings capitalization method, right? This is no more required. No more means this is not required in the net asset value method. Both the companies envisage a capitalization rate of 8%, again required only for earnings capitalization method. See, without any further information, what I can do is simply divide 300 by 8% and 10 by 8%. If no other information is given related to addition or deduction to this profit. Simply earnings capitalization. That's it. Okay. Now, H Limited has a contingent liability of 300 crore. This is a contingent liability which is never represented in the balance sheet. So this will be useful at the time of net asset value calculation. That means whatever is the net assets or the total assets according to you for H Limited, deduct 300 crore, 300 crore additional, because this is a contingent liability. Value of the company will reduce by that much. H Limited to issue 100 rupees each to the shareholders of B Limited in terms of the exchange ratio as arrived on a fair value basis. Now you have to calculate the fair value of both the companies. Let's say, for example, fair value of B Limited comes to, let's just an example to explain you the concept. Let's say the fair value of B Limited is 20 and H Limited is 20. At the end, after considering everything, you are coming to a conclusion that every share of both the companies is 20 rupees. That means if B Limited is merging in H Limited, all the shareholders of B Limited should get exactly 1 share in H Limited. Why 1 share? Because 20 by 20, the exchange ratio is coming to 1. Our share is also worth 20. Your share or your 1 share is also worth 20. So we will give you our business we will give you our entire business. You give us 1 share for 1 in our company. If I'm holding 10 lakh shares in B Limited, you should give 10 lakh shares, because the price is same. Now let me just change this entire scenario, and let's say the price of B limited is 5 and the price of H limited is 20. What will happen? Now what is the exchange ratio? B limited's one share is worth 5 rupees and H limited's one share is worth 20 rupees. Now you will understand that if B limited wants to close or give up their shareholding, that means they will give up this item, and in order to give up that, they should get something in H limited. So they should get something, that means a share in H limited, that will make them equal to what they are right now in B limited. So how many shares in H limited is worth 5? How many shares in H limited is worth 5? It's 5 by 20, that means 0.25. So this is going to be an exchange ratio. That means 0.25 shares of H limited is worth 5 rupees. 20 multiplied by 0.25 into 1 share. So 0.25 is to 1. For every share of B limited, 0.25 shares of H limited will be given to the shareholders of B limited. So all this will be calculated based on the fair price. Now don't worry about the exchange ratio merger. It will be covered under the mergers chapter. In this question, they are not asking you to calculate any kind of an exchange ratio, but they are asking you to calculate this 20 and 5. This is called as fair value. Now, what is the fair value? Please consider the weights of 1 and 3 for the value of the shares arrived on the basis of net asset value and earnings capitalization method. As I told you by the end of the previous question, see, they are asking you that whatever is the per share value of net according to this method, assign it a weight of 1 and assign this one as a weight of 3. Then calculate this, total this, and then divide it by 4 to get a fair value, because 25 and 75% weightage is given. Okay sir, we'll do that. And that's it, I think. What else? So let's first calculate the net asset value. How will you do that? Is there anything given? Exchange ratio of shares of H limited to be issued to the shareholder of B limited on a fair value. Yeah, they are asking us to calculate the exchange ratio in exactly same manner that I told you. 5 divided by 20. That means target company, the company who is getting merged, and the acquirer. Okay, we will do that. Not an issue. See, let's first calculate according to the net asset value method. Net asset means total assets minus total liabilities. For H limited, if you will see, the total asset is 13. The total asset is 1300 and there is no liability as such. See, above this liability, this relates to equity, this also relates to equity. There is no external liability to be deducted. So 1300 becomes the net asset itself minus this one adjustment of contingent liability. So 1300 minus 300 will be net asset value of the company, but we need it per share. So what are we going to do? We will divide it by 3.5 crore. So 100 divided by 3.5 will give you, 1000 divided by 3.5 will give you per share price of 285.71, which will be multiplied by 1 as the weight, and the total will be 285.71. Now coming over to H limited's B limited's price, this is 31.5. There is no contingent liability, nothing has to be deducted out of 31.5. So this becomes the total assets, this becomes the net assets. So 31.5 again divided by the number of share, that is 0.65. That's 48.46, something like this. And this will also be given as the weight of 1. Okay sir. And this information is done. Third. Now let's calculate according to earnings capitalization method. The total earnings are 300. Right. What else is required? Total earning is 310 crore. Just divide this by 8%. No extraordinary income to be adjusted, no loss to be adjusted, no additional expenses, no depreciation. Nothing is given. So directly divide this by 8%. You will get the value of the company divided by the number of shares that we have just calculated. You will get the per share price, and then give the weight of 3 to each. Now the question is very easy. See. Net asset value 1300 minus 300, that is the total 1000 divided by 3.5. This is the net asset value per share of H Limited. 31.50 net assets of B Limited divided by number of share, net asset value of B Limited. Earnings capitalization. You directly divided future maintainable profit by the cost of capital. This is called as earnings capitalization. The moment you divide 300 by 0.08, you will get the value of the business divided by total number of share. You will get per share value. In the same way for H Limited, per share value. Now understand, all of them should be given weight of 1 and these should be given weight of 3. So this is going to be 285.71. This is 48.46. Now 1071.43 into 3. This will be 3214.29. and 192.31 into 3, that is 576.93. Now there are two values for H Limited, NAV and earnings capitalization. What you are expected to do is take this one and add this one and divide the total by 4. So you will get one value of H Limited. Do the same for B Limited. Take this one and add this, divided by 4. You will get again one value of B Limited. These two values are the fair values of H Limited and B Limited, which comes to this. So every share of H Limited, is worth 875 and every share of B Limited is worth 156.3475. Now the question is, if B Limited is to close or give up his ownership in B Limited, he should get some shares of H Limited, which will be X. And how many shares of H Limited will make the value as 156.3475? Because these shareholders, in order to give up their shareholding in B Limited, will need an ownership in H Limited, which will make their value exactly equal to what it is right now, 156.3475. And the answer is very simple. 156.3475 divided by 875. 156.3475 divided by 875. That means 0.1787 share of H Limited is exactly equal to 1 share of B Limited. So for every share of B Limited, 0.1787 of H Limited should be issued. Both has the same value, which is 156.3475. That's the end of the question. In the previous question, there was no weightage given and that's why we averaged it out. In this question, the weightage are given and then we used it. Okay, sir. Question number 9 is over. Now, question number 10 is again similar to the previous two questions, but a different method. There will be two methods that we have to use to calculate the value of the company or value per share. One is the net asset value and the second one is not earnings capitalization method. According to me, it will be discounted cash flow method. I will just show you. There are two methods we have to use: aggregate discounted cash flows at 8% and net asset value. So again, there will be two different values that we are going to calculate. Okay, let's have a look on this question now. See. ABC Limited is planning to acquire and absorb the running business of XY Limited. Running business of XY Limited. We, as an AB Limited, we want to buy the company which is XY Limited. Okay. The valuation is to be based on the recommendation of merchant bankers. And the consideration is to be discharged in the form of equity shares to be issued by AB Limited. So first of all, we will calculate that what should be the value at which we are going to buy this company. And in order to pay this value to the company, we are not going to give them a cash. We will give them a shares in our company. worth that much value. So if 100 crore is become payable to that company, we will give them shares of 100 crores in our company. Is to be discharged in the form of equity shares. The paid up capital of AB Limited consists of 80 lakh shares of 10 each. So this is the data related to acquirer, 80 lakh shares of 10 each. As such, not that relevant, I think. The highest and the lowest market quotation during the last 6 months were 570 and 430. So this is the market price. This is the lowest market price and this is the highest market price during the last 6 months. For the purpose of the exchange, the price per share is to be reckoned as an average of the highest and lowest price. What is the average of the highest and lowest price, sir? It is 500. Average price of our company AB Limited is 500. That should be taken. That means every share that AB Limited is going to give to the XY Limited, it will be worth 500 rupees. So if 100 crore is the total value that we have to discharge, so 100 crore will be discharged at a price of 500 rupees. 100 divided by 500, that means 0.2 crore shares will be given to XY Limited. This is just an idea. Okay. To be very clear about this question, let me just give you an hint. AB Limited, XY Limited. We are going to value this company on some basis, and let's say for example we come to this conclusion that the value of this company is XY Limited. So there are some shareholders of this XY Limited. If XY Limited is going to be purchased by AB Limited, AB Limited has to pay something to the XY Limited shareholder. And how much amount is payable to them? 1,000 crore. But it will not be paid in cash. It will be paid in shares of AB company. And we have calculated that each shares of AB company will be worth 500 rupees. So how many shares has to be given to XY Limited shareholder? 1,000 crore rupees divided by 500 rupees of one share. That will give you around 2 crore. 2 crore shares has to be given in this manner. So what the question is asking us? The question is asking us to calculate this value 1,000 and this value we have already calculated 500. Okay. Let's turn the page. Now this is the balance sheet of the company that we want to buy, XY Limited. You can see sources of capital, share capital of 20 lakhs, equity shares of rupees 10 each, fully paid. 10 lakh equity shares of rupees 10 each, only 5 paid. That means it is not entirely paid yet. Loans of 100 lakhs is there. Total uses, that means fixed assets. This is the asset and liability. Okay, sir. Asset and the fixed assets and the net current assets. This is the liability. That means loan. Okay. An independent firm of merchant bankers engaged for the negotiation have produced the following estimates of cash flows for the business XY Limited. That means if this business is taken over by us, AB Limited, then what will be the future cash flows out of this business? 1 year, 2 year, 3 year, 4 year, 5th year, and the terminal value. Terminal value. How do you calculate the terminal value? It is calculated using the Gordon's growth model for perpetuity, and they have already calculated the same. This will be at the same year, 31st March 2011. So the timing of both of them is same. This is for the, let's say 1, 2, 3, 4, 5, 5th year, and this is also for 5th year. Do you remember this? 1, 2, 3, 4, 5. So this is first, second, third, fourth, 5th year, and this is terminal value for 5th year. So both the cash flows are at the same time if you want to discount. It is the recommendation of the merchant bankers that the business of XY Limited may be valued on the basis of average of aggregate discounted cash flows at 8%. Now start discounting at 8%, present value factor at 8%, take the present value factor at 8%, and these are the factors that you need to take. Only 2 decimal, please keep that in mind. So 0.93, 0.86, 0.79, 0.74, 0.68, 0.68. Remember that this cash flow and this cash flow is at the same time. So the present value factor will be same for both of them. Okay. Then you can just multiply and do the total. You will get the value of the total value of the business according to this method, discounted cash flow. And the second method is net asset value. It's very easy, sir. See, net assets, total assets is 350 less 100 of the loan. Net assets is total assets minus total liabilities, which is 250. That's it. See. This is the 500 rupees average price that we had calculated. Then we will do this calculation of discounted cash flow. You can see every cash flow has been multiplied with the present value factor, and straight away in the last part we have taken 300, which includes the 5th year cash flow and the terminal value discounted at this 0.68. So this is the net discounted cash flow, present value according to discounted cash flow method. This is the value of the business entire XY Limited. So if discounted cash flow method is considered, this value, the business has to be valued at 592.40 lakhs. But if you go according to the net assets, then NAV value is only 250 lakhs. And the question clearly says that the value of this business has to be the average of both. So average of both is coming to 421.20 lakhs, right? So that's this value that I was talking about, 421.20. This much has to be discharged to the shareholders of XY Limited. And this will not be discharged in cash. This will be discharged in terms of shares. That means AB Limited will give XY Limited shareholders this much value of their own shares. That means every share is worth 500, right? So divide this value by 500 to understand or to come to a value that come to a number of shares that has to be issued by AB Limited to these shareholders. So when you divide 421.20 by 500, it comes to 500.8424 lakhs. Or in another sense, 84,240 shares has to be issued to these guys, 84,240. So the moment you issue AB Limited shares to XY Limited shareholders, and that to 84,240 shares, that means this entire company is now yours. You have paid the value for that company in terms of shares, not cash. Okay, that's an easy part, 84,240, right? This is the first answer that the question asked. First or second answer, I think. Yeah, second answer. Third answer is interesting. First answer was 421.20. Second answer is 84,240 shares. And the third answer, have a look. These 84,240 shares of AB Limited will be issued to the shareholders of XY Limited. And who are the shareholders of XY Limited? These two types of shares are there. Now, these are the 20 lakh shareholders shares which are fully paid, and these are 10 lakh shares which are only 5 paid. So how will you distribute the total 84,240 share in these two different types of shares? On a basis of the paid up amount, 250 lakhs. These guys paid 200 lakhs to the company. These guys, although they are half of the previous one, but they are just 1/4 in terms of payment. They have not made the entire payment. So this cannot be the basis, 20 and 10. Number of shares will not be the basis. The amount that they have paid will become the basis. So 250 is 250 lakhs. So what are you going to do? You are going to divide these shares into 200 by 250 and 50 by 250. That's it. This is the way of allocation. Question is asking you something. What is the basis of allocation of shares among the shareholders of XY Limited? This is going to be the basis, sir. 200 by 250, 50 by 250. The amount that they have paid. See. 200 by 250. Instead of 220.25, they should have taken. See, this is not required. Fully paid up equivalent shares and everything. They are again taking on the basis of number of share, but this is increasing your calculation and unnecessary headache. You can straight away go with this 200 by 250 and then 50 by 250. This is the number of share that you should issue. 84 to 40 shares have been divided into what is the ratio of 250? I can say 80% and 20%. So directly take the weights. Now, why to do this one also and this one? Nah, 80%. Multiply it with 80% and 20%. So to the fully paid up shares, you will give 67,392, and to the partly paid up shares, you will only give 16,848 shares. These are the shares of AB Limited given to the shareholders of XY Limited because we have purchased this company. Okay, sir. Easy to understand. Question number 11 is going to be your homework. Yeah. Why question number 11 is homework? We have not seen a question like this till now. But question number 12 is similar to question number 11. And question number 12 is the latest question asked in the exam. Like question, if you will look at question number 12, this was asked in November 20 for 12 marks. So I'm going to take this question number 12, which is very much similar to 11. And that's why I have said, I'm like, you take the 11 number as an homework and 12 will be taken by us. Okay. Have a look. See, now this is an interesting question. Means I can say that this is the first question which is going to be little different than what we have learned till now. ICL is proposing to take over SVL with an objective to diversify. So again, one company wants to buy another company. The company which is the buyer is called as acquirer. And the company which is being bought is called as target. Okay. Now you can see that ICL's profit after tax has grown at 18% per annum, but that of SVL is only 15% per annum. So I can say growth rate is 18 and 15 of each company. Both the companies are paying dividend regularly. The summarized profit and loss account for both the companies are particulars: net sales, profit before interest and tax less interest, provision for tax, profit after tax, and then the dividend paid by both the company, ICL and SVL. This will be very important for you. Dividend of SVL. Okay. Then this is the balance sheet. Please understand the balance sheet. This is fixed assets. And then start the current assets. Then starts, this is the net assets. There has to be a liability part. Less current liabilities. So all these are related to current liabilities. Let me just write it like this. This is the fixed assets. This is current assets and this is current liabilities. Fixed assets, current liabilities. Then this is the net asset and then this is long-term liability. We can say capital structure. Okay. Of both the companies. So let's move ahead. You can see the paid up share capital is given 250 divided by 10. That means 25 lakh is the number of share, and in this case 125 divided by 10, that means 12.5 lakh is the number of share for SVL. Okay, sir. 1955 and 890 is the total. 1955 and 890 is the total. So this is the balance sheet total if you want to go through it. Okay. And these are the market prices of both the shares, 52 and 75. ICL's land and buildings are stated at a current price. Okay. Land and building. ICL. See, this is the land 720 and this is the 900. This is the land and building and plant and machinery of ICL, which is stated at a current price. That means it is updated. But SVL's land and building are revalued 3 years ago. There has been an increase of 30% per year in the value of land and building, and SVL is expected to grow at 18% per year each year after merger. See, if you look at this 190 figure now, they are saying that 720 is proper and up to date for ICL, but this 190 is an old figure in the SVL's balance sheet. It has already grown by 130 to the power 3 for 3 years. Last 3 years it has grown by 30%. So what is the current market price? 1.30 into equal to into 190. So the current market price of it, or current value of this, is 417.43. True? That means how much land and building has appreciated? 417.43 minus 190. So the appreciation is around 227.43. Okay, sir. Now, after the merger, SVL will expected to grow at 18% per year. In the previous part, you can see the current growth rate is 15%, but after merger, it will grow by 18%. ICL, the acquirer's management, wants to determine the premium on the shares over the current market price. Current market price is given. The current market price is 75 for the company that we want to buy. So if the payable price is coming to, let's say, 100, that means how much premium you are supposed to pay? 25 rupees. If you calculate the value to be payable to which is, what is the name, SVL. If you calculate the value of SVL and let's say it comes to around 80, that means 5 rupees extra will be paid to them. That is the premium. That's what we want to calculate, which can be paid on the acquisition of SVL. You are required to determine the premium. That means you are required to calculate first the value of the SVL. Once you calculate the value of SVL, you have to deduct it from 75 to calculate the premium in terms of rupees. And you can divide it again by 75 to calculate the premium in terms of percentage. The two methods that we want to use is net worth plus average profit after tax. That's it. This is something new. It's a single method, net worth plus average profit after tax. And the second method is the dividend growth formula, D1 divided by cost of equity minus growth. So these are the two methods out of two methods, and from each method you are going to calculate how much premium is payable or what is the value of SVL. ICL will push forward which method during the course of negotiation? See, ICL is the acquirer and it will anyhow push the method which will make them pay less for every share. Pay less for every share. Buyer always wants to pay less. So, whichever method will give you less premium will be pushed by the ICL. Whichever method will give higher premium will be pushed by SVL. Obviously, seller would want to sell it at the maximum price. Buyer would want to buy it at the lowest possible price. So let's first calculate the value per share using both these methods. Net worth. Let's first calculate. What is the net worth? Net worth is nothing but net asset value adjusted for the current value of land and building. And what exactly you have to do? See, I will show you. What is the net assets? If you go with this line, this 890 is the net assets. 890 is the net assets, and out of that I think you should deduct this borrowing of 105. Borrowing of 105, because this is also not required. Net worth, you have to take the net worth. Net worth means only equity shareholders fund will be there. So equity shareholders fund is this much only, 785. Apart from that, you are going to reduce everything. So 890 minus 105, that comes 890 minus 105 comes to around 785, plus the appreciation, because this is the adjustment in these figure. Appreciated, land and building has appreciated by 227.43, and that comes to 1012.43. This is the total net asset or net worth. That's just the net worth. But in that value 1012.43, we need to add one more thing, which is nothing but, see, average profit after tax for the next 5 years. And let's go to the previous page, because profit after tax is given in the profit and loss account, and profit and loss account is this. If you will look at this, the profit after tax is 250, but the question is not asking you the profit after tax of the current year. They are asking you the profit after tax of the next 5 years. And how will you calculate that? It's very simple. 15% is the current growth rate, sir. 15% is the current growth rate. So 1.15. It is like this. I will just write it here. 250 into 1.15. This is the first profit after tax into 1.15. This is the second profit after tax into 1.15. This is the third, 380.22 into 1.15. 437.25 into 1.15. 502.84. So just do the total of 5 next year's profit after tax. That comes to, the total comes to 1938.44. Now understand, the question says that we need to calculate the next 5 years profit after tax. So next 5 years profit after tax will be like this, with 15% growth in each year, and the total becomes 1938. And the question is very clear about that they want to take average of the next 5 years. So average of the next 5 years will be this, 1938.44 divided by 5 comes to around 387.68. 387.68. Have a look. See, 1012.43, 387.69. These are the two values. This is the net worth plus average profit after tax of the next 5 years. So first you calculated the next 5 years profit after tax, you averaged it to arrive at this, and this will give you a total of 1400.12. This is the total value of the company according to first method. Now let me reach at this once again. According to this answer, see, total assets of the company is given, which is 550 and 580. This is fixed assets, this is current assets. So this is the total assets, and after that we have taken current liabilities and borrowings. So this is what we have to reduce, total assets minus liabilities, then this is the net assets, 785. But please understand, we have to adjust the fixed assets. So what is the appreciation in fixed assets? The appreciation is 227.43. So 785 and 227.43. 785 and 227.43 is the new net asset value adjusted with the land and buildings appreciation. Net asset value 1012.43. This is the first figure. And then the question says, what is the current profit after tax? At 15% for 5 years. Okay, that's my mistake. One mistake is done here. I should have taken present value annuity factor, which is already given in the question. I didn't look at this, and I calculated like that was a clerical work, calculating every profit after tax. It has been clearly given. The future value factor of 15% for 5 years is this. You can use that to arrive at the same figure. So 250 multiplied by this 7.77, 7537 will give you the exact figure of 1938.43, and average of 1 year is divided by 5. So this is the second item, right? So the total value of the firm is 1400.12. This is what you should pay, but the current market value is 75 rupees multiplied by the number of share. So this is the total value right now, and you are supposed to pay 1400, and the difference between these two is the total premium that you will be paying, and this premium calculated on the current market value will give you a premium in terms of percentage. And there is another method also to solve this. I will just show you. In the answer, institute has showed the values in terms of total value, but we can do it like this. 1400.12, right, divided by the number of share, which was 12.5. So per share value is coming to 112.01, right, and the current market price is 75. So how much extra you are paying? Premium in terms of percentage is 112.01 minus 75 by 75. That comes to around 49.35%. Am I right, or something wrong is there? Yeah, 49.35%. So instead of calculating on the total value basis, you can calculate on the per share basis as well. So at that time, you will keep this 75 as it is and you will convert this total value into per share value. So per share and the current per share value, the prospective per share value, the difference between these two will be the premium. So this is according to the net worth method. What is going to be the discounted cash flow method? See, it's very simple. The Gordon's growth model. Let's first use the Gordon's growth model. In Gordon's growth model, we need certain figures, 1 plus G, cost of equity minus G. For SVL, we have the current prices, like 75 is the market price. And what is the dividend? Total dividend is around 125. Let's have a look. See, the total dividend is 125, but we need per share dividend and number of shares are 12.5. And the growth rate, right now, the current growth rate is 15%. We don't have cost of equity. We do not have the cost of equity given in the question at any place. So what are we going to do? It's very simple, sir. First, with the current growth rate and the current market price, calculate the current cost of equity. With this formula, the cost of equity will be 125 divided by 12.5 into 1.15 divided by 75 plus 1. So the cost of equity comes to 30.33%. Right? This is the current cost of equity. But after merger, what will happen? After merger, the other company will run this business and the growth rate will be 18% at that time. So with the new data, we can calculate the market price again. That is 125 by 12.5 into 1.18 divided by 30.33, that is 0.3033 minus 0.18. Now with this data, you can calculate the market price that you should pay. That comes to 95.70. So you can clearly see that the premium in terms of percentage is 95.70 minus current market price 75 divided by 75. And the premium is coming to somewhere like 27.60%. This premium is lesser than the previous method's premium. See, 27.60. Now what the institute has done? Exactly the same. Existing growth rate is 15%. Dividend per share is the total dividend divided by number of shares. So per share dividend is 10 rupees. Market price right now is 75. With this existing data, we calculated the cost of equity, which comes to 30.33%. And the same cost of equity is used in the new data now with 18% growth. So this was 15% and this was 18%. At 15%, the market price was 75 and at 18%, the market price is somewhere like 95.70. So the difference between these two is what you are paying as a premium. Premium 95.70 minus 75 by 75 is 27.60. Now you tell me, if you are the buyer, will you pay this price or this price? Obviously, why would you prefer to pay this one? You would prefer instead the price which is the lowest possible. So, this alternative method is considered when you take D as D1. But according to me, it should be D0 only. So this answer is right, the first answer. Institute has taken it as D0 and given the answer, and they have also taken it as D1 and given the answer. You can take it anything that's they are saying. Okay. During the course of ICL will push forward valuation based on growth rate model as it will lead to least cash outflow. ICL will always prefer to go for Gordon growth model, and SVL will go for net worth plus profit after tax model because it is giving them more of the money, right? Seller will always want higher amount, buyer will always want lower amount. So what exactly we did in this question? Very simple, sir. 75 was the current market price, and we wanted to buy this company, and we tried calculating the value. The first method was net worth plus average profit after tax, and the second method was the Gordon's growth model. That's it. According to the Gordon's growth model, the 95.70 was the per share price, and according to the net worth model, it was 112.01 rupees. Obviously, buyer would want to pay only 95.70 for this share. Why would he pay 112.01? Right? So net worth was nothing but net assets plus appreciation in land and building, because that was the only change. And profit after tax was like current profit into future value factor for 5 years divided by 5 to make it average profit. That's it. This is what we did. Now, in the previous question number 12, exactly same thing is calculated. Like, see here, premium over current. Now, this is the current question. Now, previous question. In the previous question, again, they used dividend valuation model. They calculated cost of equity using this risk-free rate of return, CAPM, then dividend, and then this. So they calculated the market price to be 494. The existing market price was 470, and according to dividend valuation model, it was coming to 494.88. So the premium was 5.29% in the dividend valuation model method. But in the method of net worth plus estimated profit for 5 years, see, this is the net assets. Value of the land and building has increased by 25% for 4 years in this case. So they took the new land and building value, then plant and machinery, everything they took. This is the total assets less total liabilities, and again reducing the loan. This is going to give you net worth. This is the net worth estimated profit for 5 years. In this question, they have not given you the future value factor, and that's why you have calculated, like every time you have calculated the value, and then it comes to somewhere around 10,743. So estimated profit for the next 5 years is 10,743. In this case, it was net worth is 8362, and you can clearly see that we are adding the entire 5 years profit in net worth. But in the current question that we have seen, we added average of the 5 years profit. But in this question, they didn't say average. That's why we added all the 5 years profit. In the next question, that is question number 13, that is the difference. The word average is the difference. In this question, it's not average. Let's have a look on the answer. So this is the answer, right? Total. So total, this is the value, and instead of dividing this by number of share, they calculated the current value 470 by multiplied by 40. Instead, what you can do is you can divide it by 470 to calculate the per share price. That comes to somewhere around, just a second, no, not 470, total number of share is 40, right? So 106.04 divided by 40, that goes to 477.65, and according to this it is 470. So these two are the prices. 7 rupees 65 paisa is extra that you are paying as a premium. That comes to only 1.63%. Let's have a look on the answer question. I will just show you that particular sentence. See, you can see the difference. It is written estimated after tax profit of the next 5 years. Nowhere here you can see that word average, and that has made the difference. This was the question asked in somewhere like RTP MTP of November 11 or 12, and after 10 years the same question was asked in exam by adding one word here, which is average. So that's the difference between the previous and this question. Rest everything is same, like 16%, 12%, 15 and 12% is the growth rate. Okay, sir. With this we end this question, and we'll stop here. We'll take a break and I will be back in the next lecture with question number 13 onwards. We are going to learn chop shop approach and more concepts are coming in the coming questions. See you.